Hi there, I'm Kristen from Gradient Accounting. In this video, we are going to be reviewing together the two most common business financial reports. Number one, the income statement, also called the profit and loss, and number two, the balance sheet. In our previous video, if you watched it, you learned that the balance sheet and income statement are required under GAAP accounting. And so it's really important that you know and understand these two tools, not only to stay in compliance, but to learn how to grow your business more sustainably. Okay, so first we're going to demonstrate the balance sheet. And I have a demo company's balance sheet right in front of me, and I want to walk you through it so you really understand each of the categories. Now, I like to think of the balance sheet as the statement of net worth of the business. So it's what you own and what you owe as a business. And this report does not get enough love, but if you want to really impress your accountant, ask them to go over the balance sheet with you or ask questions about the balance sheet because admittedly, this is our favorite of the financial reports. We definitely nerd out on stuff like this. So first in the balance sheet is always going to be listed your assets. So these are the things that you own. So what this is it's cash and anything that can be converted into cash. So as you can see here, we have the balances of this business's checking and savings account. So they're cash balances. And we also have their inventory balance, right? So they've got inventory on hand, which is another asset that they own. They also have fixed assets. So this is going to be longer term assets that the business has invested in. So think about furnitures and fixtures, even buildings, if the business bought a building or land or vehicles, all of that would be listed here. And then you may have other miscellaneous assets. Like, for example, this business has a security deposit that they paid to rent their space. So because they're expecting to receive it back, that is going to be listed here as an asset. So some other things you may see in this category is accounts receivable. And basically those represent in unpaid invoices. So if you've invoiced your clients or customers and they haven't yet paid those, but they're going to, that is going to be listed as an asset to your business. And we can get into the difference between accrual and cash basis financial statements, but that's probably going to be a whole different video at this point. And then your liabilities section is what comes next. And liabilities are all of those things that you owe. So think credit card balances. That is something you'll pretty much always see here. This business owes on sales tax because they collect sales tax from their customers with each sale, but they only remit the sales tax payment once a month. So they've got a balance in that account. And then any other miscellaneous loans, so both long-term and short-term loans, will also be listed here in liabilities. And any other bills that your business may owe money on or have to pay could also be listed under a section called accounts payable. So that is the liability section. So one thing I want to mention is that if your liabilities outweigh your assets in your business, it means that you owe more money than you have on hand. So you can also really clearly see where your cash is tied up by looking at the balance sheet. So do you have too much inventory on hand? Because if that's the case, then you may want to consider liquidating some inventory. Or do you have people that you haven't paid yet or people that haven't paid you yet? Because that should all be pretty evident from looking at the balance sheet. So the last section that I want to discuss is equity because it can be very confusing. But basically, equity is a portion of the company's assets that are owned by its owners. Now, that's such a confusing statement, but I'm going to break it down for you. So equity is going to consist of money that you contributed to the business, which would be listed as usually a category called owner's contribution. Money that you've taken out of the business, which would be listed as a category called owner's draw. Here you can see that there are two different owner's draw categories. One is owner's pay, and one is personal expenses. So this business owner clearly had some personal expenses that they ran through the business that are technically another form of owner's pay, right? So equity should always equal the difference between total assets and total liabilities. And that's why it's called a balance sheet, because equity balances it all. Equity can also be viewed for a quick health check. So if you sold all of your assets and paid off all of your liabilities, you can clearly see what your business's position is. So in this case, their equity balance is $32,000. So it's a positive equity balance, which means if they sold all of their assets and paid off all of their liabilities, they would be left with about $32,000 in undistributed cash or profit. So it's really helpful to know and understand that. And if the equity section is negative, that could mean that your business is over leveraged when it comes to debt. So maybe that your business doesn't have a ton of assets and it has a lot of debt, and therefore you don't have equity in your business at that point. So this is an important category to understand, although it can be confusing. So definitely ask questions to your accountant if it's something that you are confused about. And then one other thing about equity is there's always going to be a category called current year earnings or net profit/loss here in equity. And basically this is driven by the remaining balance on your income statement, which we're going to look at in a second. So that all kind of flows into the balance sheet. So both of the financial reports pair really nicely together. And then one last thing about the balance sheet, as you can see, there is one singular date on this balance sheet. So it's as of December 31st. So this is a point in time snapshot. It's not over a range of time. It's at a point in time. So these are all of your balances as of that very specific point in time. And that's going to be different than the income statement because when we look at that, it's going to be a range of time and it's going to encompass a period of 3 months or a year or something like that. So we can look at that later on. So a lot of times we find it really helpful to look at a comparative balance sheet to see how your balance changes over time. So you may want to look at December 31st of the prior year next to this report to see what those fluctuations were. So now we are going to switch to reviewing the income statement together, also known as the profit and loss. And I'll probably use those words interchangeably in this video. So the first thing you're going to notice on our demo is it says for the year ended December 31st. So what this means is it's not an as of date, it's a full year date, right? So it'll show your business's performance over this full year period. So something to keep in mind here. So when we're looking at the income statement, we are going to start up here at the top with revenue or income. And this is all of the money that your business brought in for this full year period. And so this is obviously a really important number to know and understand and really will tell you a lot about the health of your business. And as you can see, we have different subcategories under income, and one of them is returns and allowances. So in the accounting world, we call this a contra account because technically it's negative income, right? You're sending money back. So you may see that sitting under your income account or your cost of goods sold account, but both are accurate because it's really a subtraction of income. And then next up is your cost of goods sold. So if you are a products-based business, this will often be pretty high because it's going to be the cost to sell each of your product or the amount that you've spent on inventory, depending on how you're tracking cost of goods sold in your business. And it also will include any other variable expenses. So a really common example that you'll see here is merchant processing fees. So even a service-based business will likely have this expense, and that's going to be the percentage fee that you're paying to a credit card processor to collect those sales. And I say that that is a variable expense because obviously if your sales stopped tomorrow, this expense would be $0. So it fluctuates as your sales volume fluctuates. And so your income or revenue minus your cost of goods sold is going to be your gross profit. And this is a really important number to know and understand, especially in a products-based business and even in a service-based business, because this is often one that investors are really curious about, and they often judge your business based on how good or bad your net profit or your gross profit looks. A common term that you're going to hear in the business world is your gross profit margin. And that's very simple to calculate. It's just your gross profit divided by your total income or total revenue. And so the higher that number is, the better it looks to outsiders and investors. And that's a great way to track how your business is doing and how much of your business's sales you're getting to keep to use to facilitate other overhead expenses and pay yourself. The most important way, in our opinion, that you can use the income statement or profit and loss is to review your business's expenses. So look at it in a month view, and you can even look at months side by side. Obviously, this is a full year, and you can see the total of expenses in each category or account. So, for example, in this business, they spent $2,075 in contract labor for this full year period. And that was their second highest expense category behind wages and salaries. So it seems like most of their expenses are being spent on paying their team. But this is a really great way to just get a look at where your business's money is going and to allow you to really investigate and dig deeper into why some of these categories maybe look so high or so low. So if you're looking at this report in your accounting software, Xero or QuickBooks Online, these will also be able to be clicked into. So you can click into any of the categories and review all of the individual transactions that make up those categories, which can be very, very helpful. So what the total expenses is really will allow you to get a pulse of the overhead costs of your business, right? Because we talked about cost of goods sold as being variable, and operating expenses, or everything down here, is more so fixed costs. So even if your sales decreased, a lot of these expenses you would still have to pay for. So it's really important to understand the difference between that cost of goods sold category and the operating expenses. And then what you're left over with is your net profit or net income, or it could be a net loss, like in this situation. So because this number is negative, and because total expenses were higher than gross profit, what that means is that the business is in a net loss position. And so it's really important to understand your profitability, because I think so many businesses just look at their revenue and their income and judge their business's health based on that. Oh, well, I'm earning more than last month, so it's a great month, even though potentially they've had tons of additional expenses this month that have kicked them into potentially a net loss position. So knowing this number is important. And another important metric is going to be your net profit margin. And what this number is you would take your net income divided by your total income or total revenue. And so a healthy business has about a 5 to 10% or more net profit margin left over at the end of the day. So really it's important to understand these metrics, because if you ever want to sell your business or have additional investors come into the business, they're going to be looking at this and running these numbers the same way that we are here together today. So these financial statements that we just showed you are really tools for you to understand your business as best as you can to make educated decisions for the future of your business. So for example, if you're eyeing a new big ticket purchase, looking at your current expenses and your current profitability is a must, because if you really aren't profitable, it's really hard to justify adding an additional expense. And something else that's really helpful to consider and understand is to look at your income statement or profit and loss over different periods and compare them side by side, so you can understand the ebbs and flows of your business and the trends that you're seeing. So for example, if you consistently have a really slow month of August, it's important to know that so you can plan for it and build up a cash cushion in advance, so when the slow month does come, you are totally prepared. So those are some best practices when reviewing your financial reports, and we hope this video helps. Please do not hesitate to reach out with any questions or if you need any clarification. Thanks.